The following is a presentation of TFNN. It is now time for Trade What You See with your host, Larry Pesavento. Call now, toll free at 1-877-927-6648. Traditionally at 727-445-1044. Now, Larry Pesavento.
Okay, good afternoon, folks. And the first chart that I posted into Tiger TV was the New York Stock Exchange Index, which is the broadest and the most comprehensive of all the stock indices. And it shows that on Thursday we made a perfect 61% retracement from the low we made back on June 16th. It stopped exactly where it should have. It took out the previous low by just 3 cents, and that index is trading at 11,000, so that's basically insignificant. But we did take out the low. And so far today, we're trying to make a Gartley pattern up here at a 61% retracement, but we've not been able to do that. We've made new highs in the Dow Jones. We've made new highs in the NASDAQ, of course, but we have not done that yet in the Russell. It is lagging very badly. The S&P's not quite at new highs, but still close enough that it could be made any time, I suppose, which it probably will be. The focus of my radio show today is going to be the Bradley stock market model. I've gotten a lot of emails about that over the last few days, and especially over the weekend. And what I'd like to, I posted what the Bradley model is showing right now. But let's just go through what it does, and then I'll show you how the Bradley dates are correlated and how they're computed, and you can gauge for yourself, the value of it, because this thing goes out years in advance, and it's a basic way of looking at cycles. If you'll notice that on January 1st, right at the end of the year, we were making an inversion. We were making a bottom at that time, and the market topped and went straight down until February the 4th, which, if you'll notice, that was also a key Bradley date. And from February 4th, we've been pretty much straight up. There was a little bounce on April the 8th that caught the bottom. We had another bounce in May that was also pretty good. And then we're coming into a window now between this week on the 14th of July to the 28th of July, sets up a potential for a bearishness all the way down into November, late October, early November. Now, the Bradley model is inverted 3 times since January. That's 3 times in 6 months. That does not happen very often. The dates have been pretty accurate, but within a day or two, of course. But the overall trend is inverted 3 times, and that's incredibly unusual. I think we started looking at this from the data we had from 1875, 10 years after the Civil War. We started getting relatively good stock data from the New York Times, and if you could actually do a chart if you have the data, and we did that from 1875 up through the present date, and we find it to be about 75% accurate. When you stop and think that it can be done 1 year in advance, 2 years in advance, or 10 years or 100 years in advance, it's really an amazing way of looking at the market. Now, what Bradley did was he took cycles and built them into a sine wave. I'll just show you what the sine wave that he was working on, what it would look like. And he basically started with a sine wave, and then he gave a positive or negative weighting to the planets, and that was based on what was happening with the work was done at Princeton University by the doctor in astrophysics there. I forget his name off the top of my head, but he was a very famous astrophysicist that had said that Mars had a negative energy, Venus had a positive energy, Mercury had a positive energy, Jupiter positive, and then Uranus and Neptune negative. And they proved this by some type of electromagnetic computation, whatever it was. Well, Bradley said that if this occurs, that this should affect us, being on Earth, because our bodies are, 85% water, and if the tides move the water, they certainly move probably the water in our bodies, and maybe that affects the psychology of what we go through. So anyway, he built this sine curve, and then what he did was he came in and he gave a weighting to the planets, much like the guy's name was Burris, I believe, Dr. Charles Burris from Princeton. It starts with Barr, Charles Barr from Princeton. And he's the one that did this. Anyway, this is the valency of conjunctions that Bradley worked out. And he gave, it shows that, that the moon and the sun are basically positive, and Mercury can be positive or negative. And you'll notice that Mars is always negative, and Jupiter is 65% positive, and Saturn is almost always negative. So Mars and Saturn are very negative planets, as are Neptune. What he did is he weighted these, and then with each weight he would give it a positive, negative weighting, and then he would put it into a sine curve, a siderograph that graphed out what that graph would look like, and then he plotted it over the stock market. Well, he did this in 1946 and said this is what the stock market should do in 1947, and lo and behold, it was nearly perfect that year. It was no inversions. It just caught the bottom, it caught the top, it caught the next bottom, and caught the big rally after that. So it was an absolute amazing thing. He sold the book for $4 through Llewellyn Publications. And they, $4, back in 1947 was a lot of money, folks. I mean, when a McDonald's cost, 15 cents, you can imagine. In fact, there was no McDonald's in 1947, but that's how cheap things were back in 1947. To sell a book for $4 was quite a bit, and so Llewellyn sold very few of these books. I found the book through my teacher, Dr. Ruth Miller, back in the mid-'80s, and we started to look at it very closely in the mid-'80s, when I started working on the book Astro Cycles, The Trader's Viewpoint, and we went back and looked at the years just to prove that, this thing really did have some really good probability of making the market turn or predicting what the market was going to do. No one else has ever done that work. I don't know why, because it's certainly valid, but it certainly is statistically accurate. I would go to my grave saying that, because Jim Twentyman worked on it with me, and if there's anything that boy does is accuracy to a fault, I guess you want to say. But anyway, when you add all this up, it tells you whether you're positive or negative at the time. And what we're having now is that the Bradley model is coming over a time where you have a great deal of negativity occurring from the 14th of July all the way out into, which happens to be today, but it also extends out to the 28th of July. But from this part of July, the last 2 weeks of July, all the way through the end of October, there's a lot of negativity coming in on these planetary aspects. And since we've already inverted 3 times this year, I don't think it's going to invert the 4th time, but it certainly could. And that means we would be going up into October. There's no rules that say we can't go up forever. I mean, so far it's been going up forever, but this is what our astrology thing is telling us now, based on these cycles that we're looking at. Folks, we all know that Isaac Newton's laws are pretty strong. Number 3, especially for every action, there's an equal but opposite reaction, and we will get some changes in trend in this market. Whether it's going to be the high or whether it's just going to be our first 10% correction, no one knows, but, it just keeps going up. It stops exactly where it should have every time. On Thursday, it stopped at a perfect 61% retracement of our low from mid-June. The NASDAQ stopped at the 382 retracement. The Dow Jones stopped exactly at the 61% retracement. That was at that number we talked about last week, 16,800. We went down there and hit it like it was magic, and we, bounced off of it, very, very strongly. And so that's telling us that we still probably have more to go to the downside. Larry forgot to take his phone off the hook, so somebody's calling, and I'll try. I don't know if you can hear that or not, but I'm just going to let it ring until the break, and then I'll turn it off. So if you have any questions, it's 877-927-6648. But I did want to explain a little bit about the Bradley model, where we are, and what I see as the interpretation of it now. It's very rare that it inverts more than 3 times in 1 year, and this is what we've actually done, is invert 3 times in 1 year. So the 4th time would be unusual. The only time it's ever happened was in 1 year, I believe it was 1936, and that year it inverted 4 times, but the market was pretty much flat that year, so there was really not much going on in the marketplace itself. I've had a question about, commodities and what's been happening, to the agricultural commodities and stuff. And I would like to bring up the chart of the DBA, which is the ETF for the commodities, agricultural commodities. And you can see that chart with the DBF, which is the ETF for the agricultural, of course, and overlaid on that, on the red part of that, is corn. As you can see, corn has collapsed. It goes down just about every day. What's interesting about the corn, folks, it's going down every day, and that means you look at the open interest, and the open interest is not changing. So that means for every long that is there, it is going to be another short comes into the market. So I'm going to try to give me a second. I'm going to try to enlarge this chart for the DBA. There, I think that'll be better, and we'll be able to see it a little bit better because it's a little too small to see based on that. But it's basically showing you that these things have, we've been saying that ever since 432. Once we broke 432 in the corn, that was the last bit of support. That was a double bottom, and we've been going down. We're down another 50 cents, but it's been down every day since Moses brought the commandments down from the mount. So this has got a lot of bearishness in it, and it looks like we're not going to get any weather scare this year, but sure enough, there'll be something come up during the summer that makes the thing rally. But boy, there's certainly not a buy pattern in the corn at any time now. Wheat is the only one that looks like it has a chance of doing anything in particular. Now, the patterns that we're looking at here these are very long-term patterns that we're watching in many of these things, and I believe that as long as I don't know how high they're going to go. 17,000 in the Dow really is not anything, folks, other than a round number, because they changed the stocks that are in there. 17,000 is not a big deal, because, they took out Bank of America, Hewlett-Packard, and Alcoa and replaced it with expensive stocks like Goldman Sachs and Nike, and I can't remember the other one. But there were 3 stocks that they replaced it with, and so these were all expensive stocks. And when they take out inexpensive stocks and put in expensive stocks, you'll take a look at it. I've had a request to take a look at the Japanese yen, and I will be happy to do that right after we come after the break.
TFNN is excited about our new software charting program, The Art of Timing the Trade Charts. In collaboration with Tom O'Brien and using his best-selling book, The Art of Timing the Trade, Your Ultimate Trading Mastery System, David White has programmed an outstanding piece of software that will complement any trader's methodology. Using this first-of-its-kind program, The Art of Timing the Trade Charts allows you to scan thousands of stocks for Fibonacci formation setups, including Gartley's, ABC's, butterflies, and much more. The Art of Timing the Trade Charts is designed to help you when scouring the markets for stocks just beginning to form the trading patterns that many investors spend days, weeks, or even months searching to find. And right now, we're offering licenses available at only $79 a month. We are so confident that you're going to love this new charting software that will even give you a 30-day unconditional money-back guarantee. Don't miss out on this incredible new piece of software. Get your copy of The Art of Timing the Trade Charts today by visiting TFNN.com.
Wouldn't it be great if you could get a red light, green light indicator that gives you signals on 25 different future contracts? Now you can with Taz Signal Box. This red light, green light market profile system dynamically updates 24 hours a day and provides you with important trend and trade signals on 9 different commodities, 9 different indices, and 8 different currencies. Right now, you can receive a free 2-week trial to Taz Signal Box. For all the details and to find out how the Signal Box works, visit the front page of TFNN.com.
Andy Heck's powerful weekly newsletter, the Technomental Commodity Report, has delivered multiple triple-digit winning trades in recent months. And right now's the perfect time to get a full month-long trial to Andy's newsletter with no obligation to pay anything. Andy publishes his weekly newsletter every Thursday morning, where he breaks down the commodity market and provides his subscribers with specific trading recommendations based on his trading methodology. By signing up for a free trial to the Technomental Commodity Report, you'll get a full 30 days to try out this powerful newsletter service and see for yourself the types of trades Andy has recommended for his subscribers. When you sign up for a 30-day free trial, you're under no obligation to pay anything. And should you decide to continue, you'll lock in the low rate of only $59 a month. Sign up right now for the Technomental Commodity Report and make sure you're ready to catch the next big trade in commodities. For more information and to get started today, visit the front page of TFNN.com.
You take a hands-on approach to managing your investments, and whether you're bullish or bearish on Chinese stocks, the ETFs from Direction Shares are there to help you magnify your perspective. Bull ETFs for a rising market and bear ETFs for a falling market. Direction Shares gives you the tools for both sides of the trade. Discover how we can help at DirectionShares.com today. An investor should consider the investment objectives, risks, charges, and expenses of the Direction Shares carefully before investing. The prospectus and summary prospectus contain this and other information about Direction Shares. To obtain a prospectus or summary prospectus, please contact Direction Shares at 800-851-0511. The prospectus or summary prospectus should be read carefully before investing. An investment in the funds is subject to risk, including the possible loss of principal. The funds are designed to be utilized only by sophisticated investors such as traders and active investors employing dynamic strategies. Investors in the fund should understand the consequences of seeking daily investment results, understand the risk of shorting, and intend to actively monitor and manage their investments. Distributor Foresight Fund Services, LLC.
Many of our new listeners have heard about the Tiger's Den, but wondered, what exactly is it? The Tiger's Den is a lively community where professional traders and investors can meet, exchange ideas and information in a comfortable, moderated atmosphere. Hear all of your favorite TFNN shows, plus see all the charts as they happen live during those shows, and have access to all those charts. You can test drive the Tiger's Den absolutely free for 30 days. It will greatly enrich your knowledge of these markets. Details on the Tiger's Den are on the front page of TFNN.com. Larry takes your phone calls now. Toll free at 1-877-927-6648. Internationally at 727-445-1044.
Okay, we're back, folks, and I've posted the chart for the Japanese yen US dollar cross rate. And as you can see, we've taken out support of last month's lows. Right now, we're in the midst of about a 30 pip rally in that cross rate. But it looks to me like it's still heading down to the par level at 100. Remember, it started at 75. It went to 105. So the 382, we've been here, which is at the 100 level. We've been here for 14 weeks, and nothing has happened. Actually, this is the 16th week. And so this is very, very unusual for the market to come to this level and not either explode to the upside or break down to the upside. And that's pretty much what it looks like to me. Someone asked the question about the sentiment figures of bullishness and bearishness in the U.S. dollar. I really don't follow that at all. I follow the sentiment index for the stock market because there are more people involved with that than they are in the foreign currency markets. Even though the foreign currency markets are thousands of times bigger than the rest of the market, it's very difficult to get good consensus figures because they do it on a polling basis, and I don't know if that's the right way to do it or not. The way they do it with the stock market is they look at the recommendations coming from the brokerage houses and the newsletters and to determine who's bullish and who's bearish. With Forex, I am not sure how that works, so I don't follow it. Not that it probably doesn't work, but I just don't follow it. and see what's happening. So someone made the question here about sell in May and go away. It's not working this year, that's for sure. But we'll have to see what the end of the summer brings. But the market is actually up a little bit. It's up about 2.5% since the May highs were put in. So you have to say that if you miss that 2.5%, that's a lot more than you get at the bank that's only paying a very, very small amount. Speaking of the banking things, that one of the things that I wanted to bring up here is the fact of where we are with the if I can just get this chart to come up, I think I'll be a happy boy. Yeah, I think I will be. Hold on a second. Where is it? Here it is right here. Just give me a second. And we finally got a divergence here in the junk bonds and the 30-year bonds. In other words, junk bonds are finally starting to break away and make yield higher than the spread between the 30-year bond and the junk bond is starting to widen. It's been coming in for quite some time as everybody's clamoring for yield because they're only getting 1/4% in their passbook account, which is another way of taxing old people and young people too, but mostly old people. And but this spread has finally started to turn. Whether this is going to be an indication that rates are going to start to move quickly to the upside or not remains to be seen. But the bond market has not been able to get above that key level at 138. And as long as that does not happen, I believe that we've got a chance for the market to get to a spot where we're going to be looking at much higher interest rate prices. As you can see, the Treasury bond market has been in a bear market for quite some time. We just finished the big ABCD correction up at that 138, actually it was 139 up. That was on the 1st of June. Then we came down for 7 weeks into July, and then we've had a 7-day rally here that's taken us back to a 61% retracement near this 137.30 level, but it still looks like it wants to go to the downside to me. In other words, interest rates will be going higher, bonds will be going lower. It's even more prevalent when you look at it in context with the Treasury notes, because the Treasury notes are by far weakest of the group, and these are much bigger than the Treasury bonds. I believe it's 6 times bigger than the Treasury bonds, because Treasury notes are commercial, or is the U.S. paper, U.S. government secured paper from 2 years to 10 years. Those are Treasury notes. Past 10 years to 20, 10 and 20, and 30 are all our Treasury bonds. So it's based on the year. If it's under 2 years, it's a Treasury bill. So there's 3 ways that the Federal Reserve, issues this paper. It's no longer, backed by silver or gold like it used to be years ago. So they're called Treasury notes. The U.S. Treasury does this and then sells them to the U.S. Treasury themselves. Why we don't do our own banking, I don't know. Okay, we're going to take a little break here, and we'll be back. And we've got to talk about some gold and silver.
Has the current market volatility continued to stop you out of trades when the market spikes against you? Now is the perfect time to open up an account with Nadex. Nadex, the North American Derivatives Exchange, is a brand new, completely regulated Chicago-based exchange, and unlike most other exchanges, Nadex allows you to trade directly through them with direct market access when using their completely free trading platform, which also features real-time charts and full customization capability. One of the advantages of trading with Nadex in volatile markets is that your risk is always capped, and you have the ability of keeping your trades open even when the market spikes against you. Nadex is completely brand new with a line of unique trading products that are unavailable anywhere else. See how it works at nadex.com. That's Nadex.com. Or click on the Nadex banner on the front page of TFNN.com. Futures and options trading involves risk and may not be appropriate for all investors.
If you're an active trader looking for that extra edge when it comes to trading and investments, then now is a great time to get a 2-week free trial to Tom O'Brien's daily market letter, Market Insights. Tom O'Brien's daily newsletter, Market Insights, comes out every market day at around 9:30 a.m. and provides Tom's daily commentary on the broad market, including the Dow, NASDAQ, and S&P, plus specific trade recommendations. There's even an update published most afternoons to keep you informed about the day's market activity. He'll give you the entry price, price target, and stop price of each stock in option trade. With Market Insights, there's nothing left to guessing. For all the details and to get your 2-week free trial to Market Insights started today, visit TFNN.com.
The Path of Least Resistance is David White's daily trading newsletter, and if you're looking for active trading ideas, then now's a perfect time for a 30-day free trial to this powerful daily trading advisory service. David uses his years of trading experience to offer his subscribers his trading ideas each morning in his Path of Least Resistance newsletter. Using a combination of equity trades along with options, David keeps his subscribers up to date with all pertinent market information with intraday afternoon updates when warranted. Don't miss out on this great chance to get a 30-day free trial to David's daily newsletter, The Path of Least Resistance, with no obligation to pay anything. David has been delivering solid recommendations for his subscribers recently, and if you'd like to see the type of newsletter he delivers every morning, then visit the front page of TFNN, and you'll find The Path of Least Resistance under Trading Newsletters. For all the details and to start your 30-day free trial today, log on to TFNN.com now.
No matter where you listen to TFNN programming, we want you to know you can always access your favorite shows on demand through TFNN.com. TFNN airs live programming every market day from 9 a.m. till 6 p.m. Eastern, and you can view each program by accessing Tiger TV through our homepage. We even have an easy link for all mobile devices, including iPhones and iPads, located at the top right-hand corner of the TFNN homepage. You can use your smartphone to view Tiger TV, but if you don't have a mobile connection that can keep up with streaming live video, then you can simply visit TFNN.mobi in the browser of your smartphone for live streaming audio of all of our programs. The mission of TFNN is to educate our audience directly and interactively through our interactive website and radio call and talk shows. TFNN is able to teach all levels of investors the technical skills needed to trade in today's marketplace. In order to get the best information possible, TFNN has assembled the most respected financial minds in the country to provide the most current news and comprehensive advice available. TFNN.com, educating investors. This segment is brought to you by TFNN. Test drive all the newsletters for free at TFNN.com.
Okay, we're back, folks, and we're looking at the gold market, and as you can see, it made it 3 drives to a top pattern up around that 61% retracement at the 1338 level. We've had a good correction now, and that should bring us down to about 387, and we should be okay. The next one we're going to take a quick look at here is silver, because silver went to the 786, which is the first time it's been more bullish than gold in a long time, and it also has had a pretty good correction. So we're looking at some corrections coming here. 1287 is what we're looking at in the gold, $1,287 an ounce, and in the silver we're looking at the level of right around 2020 is what we're looking at in the silver. We've got a caller from Tampa, Florida. Scott, are you there?
I'm here, Larry. Can you hear me?
I hear you perfectly. It's good connection.
Okay, great. You know, I was going to ask you a couple questions about the British pound, and
Yes.
I sent you a couple charts, and was hoping that you could post them, and or one of them, maybe the bar chart, and spend a couple of minutes, and I'll leave some open questions for you and let it go the way it goes, and if it's a couple, maybe 5 minutes
Well, no,
or so.
we have time because, it's a very good teaching for everyone, and I know you've done a great deal of work in this area. But the one that I really liked is the one where you have the colorful, Gartley pattern built in. Do you want to talk about that one first?
We can put that up and look at it. I'm okay doing that, yes.
Okay, good. Why don't we just go ahead. Tell me what your question is or what your comment is on the chart, and we'll see if we can, get everybody to take a look at it.
Okay. First of all, this morning, where there's a blue arrow, I thought there was a chance for a long trade. And with an expectation of price somewhere up to, let's say, that middle red line there.
I understand that. It's already started working, correct?
It started, and now it's down to a double bottom as we speak here. But that one level to take a buy starts at what could be, I'll call it a more minor Gartley, an ABC lower. You can see that by the ABC line lower. Mm-hmm. And the swing would have to be the smaller swing. It's just the swing would start at the green box on the left.
I see that, yes.
But there's also a more major swing, and that swing starts at the bottom of that Gartley tool to the left.
I see that one too, yes.
And those two swings have a confluence, and if you look at the pink at 50%, and then the gray would be 618. And also, there's also an extension there, a 1.27, and you can see that from two different swings.
Sure can.
And so in looking at this, I see a possible trade here at an area of confluence, of extensions, an ABC, and yet, to my perspective, when I look at this, I see two possible areas to look at, and the one is the area that I just described to you. And then if you look at a level lower at the 786 and the 618 on the pink one, and that's using another confluence level, using a bigger swing. So I'm using two swings, a small swing, a larger swing, and I have two confluence levels. And I see at least a small opportunity, maybe for 20 or 30 pips at this level. And I drew it in, it's imaginary, an ABC lower. I see this market, I saw it possibly going higher this morning, but I'm still thinking the market is going to go lower to that larger confluence that you see as a target area with this pink Gartley.
Well, what you've done is prepared a chart perfectly for entry points. You have your first entry point, you have your second entry point, and you also don't know what's going to happen next. That's the real key here, is you really don't know. No one else does either. So that the only thing you can do is determine how much you have to risk on this trade. And the way you have it set up with the patterns and the extension, you have, I believe, at least four things coming together with the Gartley pattern, the ABCD, and the retracement at 618, and then also the extension of 1.618. All of those are coming together around this 170.40 level in the pound, so that really is pretty much etched in stone. Is that correct?
It is, and also what I used were some measured moves. That's the red and blue short lines. I know that's not something that you focus on, but that also was a confluence area added to the confluence. And when I look at the chart, I didn't draw it in here. I mean, when this market, and maybe you can comment on it, maybe it's out of context for what you want to describe here. I mean, I would kind of see the market having when you see the swings that go higher, from the lows, just looking in the past to the left. These are about 45 pip swings or so. I mean, to me, it would be like the harmonics of the swings.
Yes, that's probably close to what it is, yes.
So it would be an easy move up to where I drew the imaginary ABC. It hasn't happened yet.
That's correct. If it gets there, it certainly would be a sale, in my opinion, because you're trading with the trend. You have lower tops all along, and you have a target objective quite a bit lower. That's the ideal situation of what we're looking at.
Okay.
So I think you did a perfect job with it. I don't see how you could have done it any better.
Well, there's one thing to add to this, and for your comment. On the left, there's a green box and a yellow box.
Yes, the breakout areas.
Yeah, one's a breakout area, one's an area. I mean, they're just drawn. They're not drawn specifically and with intending great accuracy, but one's a zone area. Where buyers and sellers were going. It's an area where there are a lot of buyers and sellers playing in a range, and then it broke out. And that area is more in line with the larger with the larger Gartley going lower.
Yes.
Would that affect your strategy and the way you would use it? You could have had two Gartleys here. One's the big one that you see on this chart, and one would be a smaller one drawn from the bottom of the green box. Does that affect how you would target price looking at that area of structure to the left with the green and yellow box in some way?
Yes, it does, because that old area usually turns out to be either support or resistance, maybe for a short period of time, but you should look at that particular time it was a high, and then backed off and it went higher. But those old areas can be important. But I basically try to keep it down to just using the ratios first. 618, 786, 1.27, 1.618, and then secondarily I look at the patterns, where it's a Gartley, a butterfly, a three-drive pattern, to try to fit them all together, much like what you did in your British pound synopsis that you put up there. I mean, it's actually perfectly. I'll be surprised if the British pound does not make 170, 40 sometime here in the next few days, but I'm surprised a lot, but that's where it's supposed to be going.
And one more thing, Larry, maybe another time you get a chance to look at a chart. I didn't post it because I didn't want to make it too confusing for the couple of minutes we had. But if you look at a weekly chart on the British pound, it's got a like a three-line drive. They're perfectly spaced,
Yes.
apart, and it's an ABC on a weekly chart that it's getting close to, a target area. And
yeah,
it looks like
that's at 172. Yes, that's correct.
And it looks like it could go a lot lower if you have the patience to trade a weekly chart. And
call somebody else, Scott. I'm not going to call somebody else. I don't want to trade weekly charts. I have enough fun with dailies and hourly. No, weeklies. The problem with weekly, Scott, is you got to risk too darn much.
Okay.
Because, you can have a 0.5% or a 1% move, and that's 170 pips in the British pound, and I frankly don't want to risk 170 pips in a British pound, not the way it trades, because it hits the numbers too accurately on the half hour and the hourly, where you only have to risk, 1/2 of that, 70 or 80 pips max. So that's why I stick to the dailies and the 60-minute and the 30-minute.
Okay. Well, that's great. I appreciate your taking my call, Larry.
It's always good talking to you, my friend.
Yeah, you and I know that I've mentored with you, and it's one of the best things I ever did. And
I'll
appreciate
send you. I got that $20 check written. I just have to remember to sign it and put it in the mail, Scott.
Yeah, make sure I get it.
I will. Hey, listen, thanks for calling in, my friend.
Okay, I'll talk to you later. Thank you.
Bet. Okay, now we had someone ask questions about bullishness consensus and stuff, and I did receive something from one of my friends from the Wall Street Journal. It's from the Commodity Futures Trading Commission, and it basically shows the cash. I'm going to cover this more on the show on Thursday, but since they were talking about bullishness numbers, I wanted to show what was happening with. You can see corn and soybean prices have been really collapsing, and also wheat. And then you'll see the money. You'll see what the hedge fund people, what they've been doing, and you'll see they still have bullishness in the corn and the wheat and the beans. They still do, and the reason for that is the open interest is not dropping. Open interest is staying the same. So when someone let me try to enlarge this again, see if I can make it a little bigger for you folks. I don't know if I can or not. Wow, it did. Wow, this is actually, I can do something with this computer. I'm almost dangerous now. But it shows that you're able to you see that there's no one is leaving the market. In other words, if a short was covering, a long would be coming in, and that's what's happening here, is that there more and more people are just still betting that corn and wheat and beans are going to go higher. And they're wrong. And as you can see, the projected crop is 20% or more higher than what they were looking for originally. Now, whether that's going to be the case or not, I don't know. But frankly, I don't trust anything that the U.S. government brings out statistically. Because they change the things, they fit the graphs the way they want to. But this is a good way to get the price of corn, wheat, and beans down. That's for sure. The corn is at a low we haven't seen in several years. And wheat is also lower than it's been in the last 3 years, and soybeans are approaching that level. So they pushed prices down quite a bit, and we've got crude oil breaking. It's almost below $100 a barrel now. So we've got some deflation, coming across the bow here in some of these things. So it's important that we remember that things like this can happen. And that's the one thing that the Federal Reserve is most afraid of is the deflation. They don't think that could ever happen. And maybe it can't. Okay, we're going to take a look here at the, just a second, I'm going to show the Russell. I want to bring the Russell chart up here because someone asked for a question. You'll see that the Russell has had very little bit of a rally here. I mean, almost nothing. The same thing with the IBB. Both of those have been rallying. It's mainly some really big NASDAQ stocks that are making this thing move. And the Russell is really doing very much. Now, the Russell stopped exactly at the 50% retracement on last Thursday, and now we've had the good rally. We opened sharply higher, and it's already given back quite a bit of its gains, but whether that's going to mean anything or not, I don't know. You can see the difference between the S&P 500 and the Russell because, when the Russell was backing off into, late June, the S&P was not backing off at all. It was just basically on its way, pretty much straight up into May, whereas we did make a bottom at a 61% retracement in the Russell, and now we've hit that level. So we'll see how this thing is going to pan out. The rally today has been very, very weak in the Russell, to say the least. Most of it is done in the banking sector and the consumer staples and stuff it appears to be looking at. Now, we should take a look at the VIX index here because we listened to our friend Basil last week, and he said the importance of it getting above that the 1250 level, and we couldn't do it. We only got to like 1220, and now we're making a 61% retracement of the low we made back on July 3rd, right before the holiday. Now, whether this is going to hold the market from going any higher or not, we'll have to wait and see. We've got another huge gap down. Folks, the good part about this is that we've got game. We've got players coming in now. And not only that, but we've got people that are actually coming into the market. And you don't see it, but you're seeing volatility because you're seeing swings that we don't usually see. And that's what we want. We want these 15 and 20 and 30-point swings in the S&P and 100 and 200 points in the Dow Jones, because that's where the patterns come to the best, and that's where they have the really, really interesting spot to see whether we're going to have a two-way market. Now, the low today, it's very important to me, and I listened to Basil. He talked about the importance of this 1140 level in the VIX, but that 1140 level in the VIX, I'm going to draw this in so you can see it, because to me, this thing really does a good job at picking out the extremes of the market. I'm not sure why it works the way that it does. I've only traded it about a dozen times in all the years I've been trading. Of course, it hasn't been around that much. Anyway, we'll take a little break here, and then we'll be right back.
Daryl Martin coined the phrase diagnostic trading, and we're happy to announce that his diagnostic box spread analyzer has finally been released. The Diagnostic Box Spread Analyzer helps you easily identify the best box spreads on Nadex in seconds, plus you receive access to the diagnostic deviation levels, as well as step-by-step training videos teaching you how to trade Nadex spreads so you can quickly master the mechanics of this simple yet powerful trading instrument. By pulling live data from the Nadex exchange, the Diagnostic Box Spread Analyzer does all the math for you, calculating risk, reward potential, distance to break even for both outright spreads and spreads used to hedge the underlying market. Visit the front page of TFNN.com today to get your 2-week free trial to Daryl Martin's Diagnostic Box Spread Analyzer and gain access to the valuable information it can provide when trading the Nadex box spreads.
Tom O'Brien's weekly gold letter, The Gold Report, gives complete and concise coverage of the entire gold market. Inside, you'll get Tom's commentary on gold, the dollar, the rand, the bond, the XAU, the HUI, and detailed coverage of nearly 25 mining stocks. He'll give you the entry price, price target, and stop price of each stock trade. The Gold Report is a long-term newsletter where the focus is on building real wealth through the management of a successful portfolio of gold stocks. With a lifetime of knowledge and almost 12 years of writing his informative weekly newsletter, The Gold Report, Tom O'Brien can provide you with the important market information to help you make better trades in the gold market. Don't let the next bull run in gold pass you by. To get a month-long free trial to The Gold Report, an $85 value, visit the front page of TFNN.com today.
David White's newsletter, The Technology Insider, is focused like a laser on finding the next big things in technology. If you had invested only $10,000 in Microsoft in 1986, you'd have been a millionaire by 2000. Disruptive technology like Microsoft's is the key to these massive long-term profits, and the Tech Insider is the vehicle from TFNN to capitalize on these opportunities. This is the go-to newsletter that identifies, monitors, and profits on mostly little-known cutting-edge companies with great long-term prospects. David's experience is as an inventor of Emmy-winning animation products for TV and Hollywood that propelled a company public. Match that with 14 years as a full-time trader, and he's uniquely qualified to guide you through the light-speed world of ever-evolving high-tech. If you're ready to ride the next big technology bull market for less than $40 per month, log on to TFNN.com and get your 2-week free trial to the Technology Insider. Get in on the ground floor of the next big thing today.
We're told to follow our passion and everything else will fall into place. I hope that's what each of you are doing each and every day. Hi, I'm Steve Rhodes, host of the Money Master Show at TFN.com, and my passion for technical analysis is what led me to the most fundamental discovery in pattern recognition, the Rhodes Momentum Indicator, market scanner, and trading strategy, a set of tools that identify the momentum and power of the trend, the likes of which have never been seen before, for every market and every time frame. Yes, folks, the trend is your friend, unless you're on the other side. New to technical analysis? This is the place to start. And experienced traders, take advantage of the trend like never before. Experience the power of the Rhodes Momentum Indicator each day, available to subscribers of my newsletter service, Mastering Probability. I guarantee your satisfaction for the next 30 days unconditionally, so there's no risk to you other than being on the wrong side of the trend. Mastering Probability, available on the homepage of TFNN.com. And folks, live with passion.
Up next, the Diagnostics Trading Hour with Daryl Martin here on TFNN.
Okay, we're back, folks, and I've posted the chart of the VIX index over the last month, and it shows the high we made last week, and the pullback that we've had so far today has stopped at exactly the 61% retracement of that move. And I think that is relatively important. The next chart is the one that I started the show with, that I actually drawn in the ABCD pattern in the New York Stock Exchange Index. This is the real market, folks. This is every issue cap weighted, and this is what the real market is doing. I know we made new highs in the NASDAQ. We made new highs in the Dow. So that's 100. That's 130 stocks out of 7,000. So the rest of the market hasn't even made a 61% retracement of that, and the Russell hasn't even made a 382. Whether that means anything, I'm not sure. All I know is that we are coming into the window of the Bradley model, and I know it hasn't worked it worked the last 3 times, but it inverted quickly. I mean, it did really good job at picking highs and lows, but it didn't stay with it for a very long period of time. My comment here is the Bradley model has inverted 3 times since December, and the number of times that it's inverted, 4 times, in the 140 years that we've been doing it, I think it's been 7 times in 140 years we're inverted 4 times. It is never inverted 5 times. The dates were good, but so we'll see. The thing is that if we do roll over in here sometime in the rest of this decade, and we've got 6 more years to go, we should be able to take advantage of it. I'm sort of being facetious because we're in this time zone here from July 14th until July 28th. We could still go up through to July 28th because that's the last of the Bradley dates that we're looking at, but this is the first, and the fact that we're making a new high in some of the indexes and the others we're not could be very, very important. I'm not sure. I don't know what the emotionalism is. It might be the fact that Germany beat Argentina in soccer, which I certainly don't understand anything about it, and but I guess it's a very popular game. Anyway. This is what we're looking at. It's going to be really interesting here this week to see what happens with the markets. We had the super full moon come in on Friday, and if you had a chance to go out and look at it, it's really spectacular. We're at perigee today. That is where the moon is as close to the Earth that it gets. It's closer by 10,000 miles because of the wobbling effect that we have. There's a 10,000 mile difference between apogee, which is as far as away it gets to the Earth, and perigee as close as it gets to the Earth, and this is where we are now. What's interesting is when it moves from perigee to apogee, this is when you have a tendency, because of that gravitational pull, we have a tendency for bigger earthquakes. So we could have a bigger earthquake in the next day or two. So if you're in Vegas, put $1 down on earthquake. No, they don't do that. But I was thinking this might happen. Who knows? I'm just saying that statistically that's what the odds are because of that gravitational pull. We still got the Dow up triple digits. The NASDAQ is up in new high grounds. The S&P has not made new highs as of yet. We're still only about 7 or 8 points away, which could be done before the end of the day. But the Russell is backed off quite a bit. We made new highs in the transportations. The utilities are rallying back from the high they made several weeks ago. But the market is still quite strong as we go into the halfway session with 3 hours to go. So that's what we're looking at. On Thursday's show, I'm going to have, on the commodity show, I'm not going to be able to be here because of a speaking engagement I have at the Market Technicians Association meeting in Seattle. So live every day in an attitude of gratitude, and may God bless.
Since 1984, Basil Chapman has been using the Chapman Wave methodology to advise traders of his expert market opinion. While originally hand-drawing charts from the late 1970s into the 1980s, Basil noticed that prices under most circumstances virtually always had a certain number of legs to the upside before declining sharply. Later, Basil found that computer software, which included the standard market technical indicators, enhanced the degree of accuracy in calling price turns, as well as market trend calls. Thus was born the Chapman Wave sequence. Using the Chapman Wave methodology along with other indicators, Basil Chapman advises his subscribers of his expert market opinion each market day with his opening call newsletter. Right now, you can get a 2-week free trial to the opening call, Basil's daily trading newsletter, by visiting the front page of TFNN.com. Cancel at any time during that trial and pay absolutely nothing. Get your 2-week free trial to Basil's newsletter, The Opening Call, today by visiting TFNN.com.
You're watching Tiger TV.